Many of the financial gurus out there will tell you that you should never take a 401k loan because you don't want to miss out on all those sweet compounding dollars. As a general rule, for most people, and at most times, that is probably sound advice. Before I jump in with a counterpoint to that, I want to preface this with a disclaimer. I'm not a financial advisor, and I do not know all of your circumstances, so you should seek advice for your particular situation before making any large financial decisions. If you want to see more videos like this, make sure tapping's happening on that like button. It really helps with the almighty algorithm. Drop a comment below for strategies you want to know more about. The primary focus of this channel is to enable people to achieve financial freedom, so subscribe to follow our content. We also leave some info and links in the video description, so check that out to learn more. Now there are a few things that you should know about a 401k loan. There's often a small origination fee involved with taking the loan, so it's better to do one larger loan since it is a flat fee. If you leave your job, then you will need to pay the entire loan in full or risk 401k withdrawal penalties. The term limit for the loan is 5 years. The term is 50% of your balance or $50,000, whichever is lower. The interest on the loan goes into your 401k account, so in a sense, you're paying interest to yourself. The saying goes, time in the market beats timing the market, but sometimes it can be clear that the market is likely at a high point. That is the time to execute on a strategy like this. A 401k loan actually increases your timeline for dollar cost averaging. In effect, it increases the amount that you are contributing to your 401k on a monthly basis because your loan payments are like extra contributions. Ideally, you take a loan at a peak or in a stagnant market. Use the loan to offset interest elsewhere and pay back the loan over a longer period. So how can you use this to your advantage? The first circumstance is a person who has higher interest loans or lines of credit with large balances. Since 401k interest is paid to your own account, it can even make sense to offset lower interest, but that is less cut and dry because you still run the risk of missing out on market gains. The idea behind this strategy is to lock in gains when you think the market is due for a correction or a slowdown. The 401k loan does not involve your credit, so if your credit is not great, then a car loan is an example of where you might have a higher rate compared to the 401k loan. Let's say you have a $40,000 car loan at a 4.5% rate. This is a loan calculator that I will link in the video description. The payment ends up as $745.72 per month for a 60-month term. A fixed rate and term loan will have something called an amortization schedule, which is basically the breakdown of the payment by interest and principal for the life of the loan. Now if we look at the amortization schedule for this loan, you can see that the interest part of the first payment is $150 and goes down each month. By the end of the loan term, you'll have paid $4,743.25 in interest to the finance company if you make the regular monthly payments. Now let's run through the same numbers with a 401k loan, with a $100 origination cost and a 3% interest rate. The first thing we see here is the payment is now $718.75, which increases your monthly cash flow by almost $27. You can see that the first month of interest ends up recapturing the loan origination cost by paying $100 in interest to your account. After that, the effective rate of return is 7.5% because now you are offsetting 4.5% interest that would have otherwise gone to someone else, and then paying 3% interest into your 401k account. This is a case of guaranteed earnings that you would have missed out on. The downside is that you could be missing out on really large gains in the market for that money. But that is why you execute this strategy when you think the market is inflated or will stagnate. At the time of making this video in late 2021, many people think that time is now. The potential upside here is you are going to be shielding that loan amount from losses during a bear market. If the market takes a 10% correction, that actually adds to your gains. One bonus with this strategy is the ability to pay off the loan early to buy the dip of the market. Most 401k administrators allow for an early payoff, so check to make sure that is true in your case. Another scenario in which you can use a 401k loan to build wealth is if you have a business and you need money for a business expense like inventory. You can use the 401k loan for startup costs, but just keep in mind that many small businesses fail, so we do not tend to recommend risky investments with retirement funds. In the case of using the funds for high-yield business investments, that can be a no-brainer. Let's say you have pre-sold orders for $100,000 and the inventory will cost you $40,000 to fulfill the orders, but your cash on hand is not enough to buy the inventory. That drastically increases your ROI over almost anything you can do in a 401k account. If you found this video useful, go ahead and loan us a like to get us a return from the algorithm. Comment below with questions or tell us we are wrong and Dave Ramsey has all the answers. Subscribe to learn more about long-term wealth building strategies to help you on your journey to financial freedom. Check out the video description if you'd like us to help you make moves on that journey.